Free cash flow is how much profits you have left after all cash outflows are accounted for, along with the cash used to maintain capital assets. This means that it's the free cash available at the end of the period that you can spend on anything. In comparison to net income, it's more of an actual profit. Net income includes things like depreciation and amortization that got accounted for more as just a place here to fill in the money rather than actual spending of the money in that year. And to calculate the free cash flow projection, it would be free cash flow is operating cash flow. Operating cash flow minus capital expenditures. This looks simple here, but it gets broken down. Specifically, operating cash flow gets broken down into numerous pieces. This operating cash flow minus capital expenditures can also be broken down into earnings before interest and taxes times 1 minus the tax rate. Plus depreciation and amortization. Plus, in this case, it's just depreciation. And then minus capital expenditures. Minus changes in working capital. Or in net operating working capital. Should then leave you at free cash flow. You can then take your earnings before taxes of 156, add back your interest expense because it's earnings before interest and taxes. So you can add back your plus 178 minus your then tax rate, which it gives you instead of having to compute it with a percentage, provision for tax of $61. And then add back your depreciation, which is $1,061, because that's money that was spent in the past. It's not actually cash going out. Then you can move on to your capital expenditures. Moving on to capital expenditures, you would take your gross property and equipment. It's normally property, plant, and equipment, but no plant in this case. Your current year of 6410 minus previous year of 5,149. And then you would add back on the accumulated depreciation for the current year because it's building up over time, plus $2,714. And then you can move on to your changes in working capital. For net operating working capital for 20x2, it'd be, let's go down here, leave a space to finish the problem. Net operating working capital 20x2, it's current assets, which would be cash security or cash and securities, accounts receivable, inventory, and other current assets, which is 1412, minus any excess cash, which there's not excess cash around, minus the current liabilities, which are down here, total current liabilities of 1218 minus notes payable, we don't have any, so minus 0. And then net operating working capital for 20x1 would be, once again, the current assets for that year, which is $1,234 minus no extra cash minus current liabilities of $796 minus 0 notes payable, this brings us to $194 and $438. Then the changes would be, or for up here, changes in net operating working capital. Current year of $194 minus the prior year of $438, which would give you negative $244. Then you go up here, this equals, and then bring in changes in working capital at minus 244. 8 minus 61 equals. So then you have $1,334 minus capital expenditures of $3,975, and then this would be minus the 244, but since it's negative 244, you have to add it, which brings us with a free cash flow of negative $2,397. This massive negative 2,397, which in this case is actually in the billions because these are all million numbers, so negative almost $2.4 billion is mainly from these capital expenditures. It's just buying buildings, maintaining buildings, things like that that are quite pricey, but they don't technically affect the operating income, but they'd be reflected in the free cash flow.